All right, so let me minimize the screen so that way we are not distracted. Peace, everybody. Thank you guys for tuning in, man. We only got six people on the call, but I don't care. Those six people are about to get some really interesting information about the state of Bitcoin. We often argue online about price of Bitcoin. We often tell people that uh, Bitcoin is inferior to this product or that crypto or this project, or you know what I'm saying. We always find ourselves in an argument with someone, especially the XRP military, when it comes to Bitcoin and blockchain and DeFi. So I just wanted to really come over here and give you guys kind of like a state of address, if you will, when it comes to Bitcoin and what is happening with Bitcoin and the absolute truth that is taking place within the blockchain space and how Bitcoin is playing a very major part, not only when it comes to the asset that is Bitcoin, but how the banking framework is changing as it pertains to Bitcoin. First and foremost, y'all already know this is not financial advice. Please do not take this as such. This is 100% for education and entertainment purposes only. I am not a financial advisor. Please do not take this as financial advice. Always do your due diligence on anything and everything that I'm saying. I could be 100% wrong on this shit, but I've done my research and I'm here to tell you right now, you probably not even thinking about the way that this shit is getting ready to go. That's just me keeping it above. So, if you need financial advice, please reach out to any financial advisor that you might feel like would tell you the truth about Bitcoin. I guarantee you, if you do reach out to a financial advisor, they're just going to tell you about price. They're not going to tell you what I'm about to get ready to tell you. So, consider yourselves lucky. So, I titled this The Sovereign Collateralization of Bitcoin, the layer two scaling, housing finance integration, and the state by state fiduciary banking frameworks, the macro financial transition, Bitcoin as a productive collateral asset. Now, I just said a mouthful. I just said a whole mouthful because most people don't even look at crypto. I'm not even gonna say Bitcoin. Most people don't even look at crypto as being a productive collateral asset. Most people don't even understand that crypto is an asset. They just buy it and sell it and buy it and sell it. And next thing you know, they're involved with all of these different what I want to say not Ponzi's, these matrix schemes, you know, that sign one per or sign three people up, and out of those three signups, you're going to get half of the proceeds that they put in, and those three people sign up, and those three people sign up. That's not what Bitcoin was created for. So, without further ado, let's go ahead and get started, y'all. So, let me pull this down. The digital asset market has expanded a structural shift in the utility profile of Bitcoin. Historically characterized as a speculative static store of value, the asset is transitioning into a highly liquid, productive. Let's keep saying that word. You're going to keep hearing me say that word. Productive global collateral layer integrated into both decentralized and traditional financial market infrastructures. This evolution is necessitated by the inherent physical limitations of the Bitcoin layer 1 blockchain, which is structurally constrained by the blockchain scalability trilemma. Because scaling the base layer directly would require compromises in either network security or decentralization, the average throughput of the Bitcoin mainnet remains limited to approximately 7 transactions per second. I'm going to pause right there for a second. With Bitcoin, with the price of Bitcoin, with the underlying value of Bitcoin, which is roughly around 1.5 trillion, approaching $2 trillion, it takes entirely too long for a transaction to complete. I know most of y'all on this call have been through going to purchase Bitcoin, and as soon as you purchase it, probably in your first time purchasing it and trying to transfer it, it probably took an hour, maybe 3, for you to get that Bitcoin in your wallet. And you were probably on pins and needles too, like, oh shit, where is my Bitcoin at? It's taking forever. That's what they're talking about. We are talking about the fact that Bitcoin is such an heavy asset that it only allows for 7 transactions per second. That is entirely too slow for global finance. Hence the word global. Now, with an average block finality time of 10 minutes, these baselines or these baseline performance parameters create transaction execution bottlenecks that make high volume payments or complex financial contract settlement unfeasible on the mainnet. To unlock the dormant liquidity of the underlying asset, the ecosystem has developed a modular scaling paradigm where transaction execution is offloaded to layer 2 or L2 networks. Excuse me. Let me pull this down a little more. L2 networks, while consensus and settlement are anchored back to the highly secure L1 chain. Unlike sovereign layer 1 blockchains, these L2 networks do not maintain an independent security budget. Instead, they periodically settle state updates to the Bitcoin mainnet, effectively inheriting its substantial proof of work security budget. This institutionalization of the modular infrastructure has attracted significant capital commitments. Now, pay attention to this part, and this is very important. Between 2018 and 2024, late 2024, crypto-focused venture capital firms directed a total of $447 million into Bitcoin L2 protocols, with more than 36% of that total funding allocated in 2024 alone. These capital flows are driving the development of robust applications designed to bridge native Bitcoin holders into active yield-bearing structures. Industry projections indicate that while wrapped and staked iterations of Bitcoin only account for 0.8% of the circulating supply in late 2024, approximately 2.3% of Bitcoin's total circulating supply, estimated at over $47 billion, will be active within the Bitcoin L2 ecosystem by 2030. I'm going to pause right here. Do you guys know about any of the Bitcoin layer 2 structures that have been created. And I'm not going to name any projects, but let me just ask that question. Is anyone here familiar with Bitcoin layer 2? Feel free to come off mute or you can type it into the chat. I don't want to hold this up for too long.
I think so. I don't know why you don't, why you're not naming the projects, but I think
No, I'm not going to name no projects
I,
because
I, I think
I,
I heard.
I really want people to do their own research because if I get the name in the projects, then that's me almost making the suggestions for you to check out those said projects. So all you got to do is search Bitcoin Layer 2 ecosystem and you'll find all of the projects. If you go to CoinGecko and you look for the Bitcoin Layer 2 category, it'll tell you exactly all of the projects that are dealing with Bitcoin Layer 2. Now, the structural typologies of the Bitcoin Layer 2 landscape. The Bitcoin L2 ecosystem of 2026 is highly heterogeneous, comprising several distinct technical architectures tailored for payments, contract execution, and institutional asset issuance. They are categorized into these categories: layer 2 protocol, core technical architecture, primary functional focus, native asset mechanics, key scalability, and operational metrics. The first one is Lightning Network, bidirectional payment channels, high speed retail and micropayments, multi signature locked native Bitcoin, capacity of sub-second settlement. The second one is Spark, off-chain state chain protocol, zero fee peer-to-peer transfers, jointly co-signed off-chain state, focuses on instant payments without channel liquidity constraints. The next one is Stacks, sovereign smart contract layer, smart contract execution and DHAP hosting, synchronized block consensus with L1, bridges smart contract programmability to native Bitcoin collateral. The next one is the Liquid Network, federated sidechain, asset tokenization and real world issuance, two-way peg of conversion from Bitcoin to LBTC, optimizes institutional transfers and private settlement. The next one is Rootstock or RSK, EVM compatible sidechain, Ethereum equivalent smart contracts, merged mining with Bitcoin L1 validators, and allows Ethereum native protocols to operate with BTC backing. Now, this one I haven't heard of before. This Citria is zero knowledge rollup or the ZK rollup. If you haven't heard of a ZK rollup, it's zero knowledge, means that the transaction is private. Definitely do your research on that. Trust, minimize execution scaling, batched off-chain state settlement on L1, inherits Bitcoin L1 data availability and consensus verification. The Lightning Network remains the most structurally mature execution layer for payments. By enabling parties to establish off-chain payment channels secured by multi-signature addresses, The protocol bypasses mainnet block space limits, offering transaction fees measured in fractions of a cent. The operational usability of the network has been enhanced by the deployment of Bolt 12 offers for reusable payment codes, splicing techniques to resize payment channels dynamically without closing them, and the emergence of specialized Lightning service providers, LSPs, that automate channel liquidity management for enterprise applications. Now, I'm saying a mouthful, so I'm going to try to break it down as best as I can because, again, this is high level, but this is what is happening with Bitcoin. We are looking to use Bitcoin as a form of payment, but Bitcoin is entirely too heavy. You can't use Bitcoin as a form of payment. So, what do? You create a layer on top of Bitcoin. And for the payments to actually process and be able to be used again, you're going to have to split or reuse the payment codes without actually touching the physical Bitcoin. What that means for Bitcoin holders is that you are the foundation. We are the foundation. We will be paid for providing our physical Bitcoin so that a layer two or a layer on top of Bitcoin can be established. It can't be established without the physical Bitcoin. It has to be established with the layer one. So if that makes sense, please drop a one in the chat. I want to make sure I'm trying to keep you guys uh as close as possible to what I'm explaining. Now, if it doesn't, drop a two in the chat and let's have a real conversation about what you don't or what you might not understand. Okay, everybody is following. Thank you. Awesome. Awesome. Thank you. I want to make sure I'm keeping you guys because sometimes I can go over people's heads and they'll leave this and be like, you know what? I didn't understand shit Bankroll was saying. And I tend to do that. So that's why I'll try to slow it down, bring it back to reality, and show you guys exactly what is really happening. Because no one is talking about what is really happening with Bitcoin. Everybody is focused on price. And we are so far past price. It's ridiculous. It's ridiculous. Let's really dive into this. So, despite the advancements, let me take the chat again. Hold on. For sure. No doubt, Skull. I'm glad it helped, bro. Because that's what I know this can get a little too high level. That's why I wanted to explain it a little bit. Okay. So, despite these advancements, payment centric networks like Lightning are structurally limited as they do not support stateful smart contracts. I'm going to say that one more time. Despite these advancements, payment centric networks like Lightning are structurally limited as they do not support stateful smart contracts or expressive financial agreements. Now, this world that we are currently operating in is just a layer on top of a layer on top of a layer. What you think you see in dollars, where's my dollars? My wife must have moved them. What you think you see in dollars is actually far more complex than what you're physically seeing. There are multiple different networks that have to be processed when you are issuing just a simple dollar as payment. And those financial agreements have to be in place that says we accept that dollar as payment. So these payment centric networks, they do not support the stateful smart contract of an expressive financial agreement. So they got to create another layer. For advanced financial activities such as yield generation, lending, or real world asset tokenization, institutions are adopting smart contract side chains like Stacks or Rootstock, along with zero knowledge rollup networks like Cetria, which verify transactional state changes directly on the base layer via cryptographic proofs. Okay. They have to create these different side chains. So while we're creating different layers, there are also different side chains that are being created. And this is just the beginning. This is just the beginning. This is not the entire thing, it's just the beginning. We are creating layers of finance on top of Bitcoin. This shit about to get deep. Check me out. So the institutional integration, the spot ETFs, and corporate balance sheet strategies. The institutional integration of Bitcoin, excuse me, into traditional capital markets has matured through true primary transitional channels. The expansion of spot exchange traded funds, ETFs, and the emergence of corporate digital asset treasury frameworks, DATs, spot ETF liquidity dynamics, and custodial risk analysis. Following the Securities and Exchange Commission's SEC initial approvals in January 2024, spot Bitcoin ETFs have become a primary method for institutional capital allocation. By late 2025, cumulative assets under management, AUMs, in the US listed spot Bitcoin ETFs surpassed $95 billion. Passed it. 95 billion. The institutional inflows trend reflects a programmatic, programmatic long-term portfolio allocation rather than speculative short-term trading. This persistent institutional demand has led analysts to project that exchange traded products, ETPs, could absorb more than 100% of new issuance of major digital assets, driving the total global crypto ETP assets under management toward a projected 400 billion. This right here, just this portion, institutions have already entered the game. And that's just a drop in the bucket. $400 billion is a drop in the bucket for institutions. They're building. While we're arguing over price, they're building. While we're arguing over who has the better asset, they're building. While we're arguing over which crypto is the best, they're building. Spot Bitcoin ETF, ticker, total assets under management, net expense ratio, design custody institution, market liquidity, and volume metrics. iShares Bitcoin Trust, IBIT. Total assets under management, 87.3 billion. Net expense ratio is 0.25%. The designated custody institution is Coinbase Custody. Holds market share averages 800 million to 1.2 billion dollars in daily volume. Now, the interesting thing that I want y'all to pay attention to is if we have built layers on top of Bitcoin, then we are not actually trading spot price. If we're not trading spot price, what do you think we're trading? Somebody answer that question. If we're not trading spot price, what do you think is being traded? I'll give y'all a moment. I'm going to let y'all think on that one. I'm going to wait for somebody to answer. Nobody got it? Nobody can tell me what you think is being traded?
Is it futures?
That's very close. That's very close, bro. Keep that same thought process. What?
Utility?
Say that again?
Utility?
Nope, not utility. That's
Derivative?
close. The derivative. What is the derivative? It's one word. What is a derivative?
It's
Paper.
a, yeah, it's an instrument or a product. It's not the real thing.
Paper. That's all they're trading. Paper. They put a value on the paper, and that paper gets traded. How does that paper get traded? Through the market. So we're not trading spot price. We're trading what Brother Scott just said, futures and derivatives. The market is over leveraged by futures and derivatives. So the true spot price hasn't even been tied in yet. So the price that you see for Bitcoin, as we were just at 124,000, and now we're sitting at somewhere around between 63 and $64,000 on Bitcoin, that is just a derivative price. Once they start integrating true spot price, where you no longer have access to spot because all of the supply has been accumulated, that is going to create shock. Right now, all of the Bitcoin has not even been accumulated. It's going to take years for all of the Bitcoin to be accumulated. So they have to create paper. And that's all we're looking at right now. iShares Bitcoin Trust, that's paper. Fidelity Wise Origin, FBTC, that's paper. Grayscale Bitcoin Trust, paper. Morgan Stanley Bitcoin Trust, paper. Didn't Jamie Dimon just say he didn't like what's the dude name? Brian Armstrong? Say he was full of shit. Why do y'all have a Bitcoin trust in Morgan Stanley? The structural expansion of the spot ETF market has introduced a critical concentration risk. Let's talk about that. Hold on. Somebody drop something in the chat. So there is no true spot price for Bitcoin. If there's no true spot price for Bitcoin, Sister Life, that means that Bitcoin is undervalued. That means that there is no top for the price of Bitcoin. No ceiling. None. That was a good question. That was a really good question. Check this out. I'm going to read this last sentence one more time. The structural expansion of the spot ETF market has introduced a critical concentration risk. The vast majority of the leading funds, including BlackRock's IBIT and Grayscale's GBTC, utilize Coinbase's custody as their sole asset custodian. This high concentration within a single institutional grade private ledger centralized on Coinbase Prime means that any operational failure, regulatory action, or systemic disruption at Coinbase could impact the pricing and redemption mechanics of the entire institutional investment landscape. Creating this paper has fucked up the price of Bitcoin. It has created corruption. To address this concentration risk, newer institutional entrants, such as Morgan Stanley Bitcoin Trust, have implemented a hybrid custody model, splitting custodial responsibilities between the Bank of New York, Mellon, BNY, Mellon, and Coinbase custody to ensure greater systemic resilience. The corporate treasury paradigm and debt financed accumulation. Y'all getting some shit today. Y'all wasn't expecting this. I guarantee y'all wasn't looking for this when I was talking about the truth about Bitcoin. I promise. So, in parallel to exchange traded funds, public and private companies are adopting the digital asset treasury playbook to optimize their corporate balance sheets. This balance sheet strategy is led by Strategy, formerly MicroStrategy, which by mid 2026 accumulated over 818,000 Bitcoin, valued at approximately $66 billion, representing roughly 4% of the total circulating supply. Y'all didn't even know that that amount was available. Most people don't know that that amount was available. He accumulated. That's 4% of the total circulating supply. Strategy financed this rapid accumulation through the corporate debt and preferred equity markets, issuing structured high-yield perpetual preferred shares to institutional buyers. These issuances include STRK, preferred shares carrying an 8% accumulative annual interest rate, STRF, STRD, preferred series carrying a 10% annual dividend rate, STRC, preferred or perpetual preferred shares carrying an 11.5% annual dividend paid weekly, which raised approximately $10.5 billion. Excuse me. Hold on. I went too far. Hold on. I got you, Sco. I went too far. Hold on. Right back here. Bring it back. Bring it back. Bring it back. Hold on. Okay. I got you, Sco. Give me 1 second. Let me finish this and I got you. While Strategy maintains a cash reserve of $900 million as of mid 2026 to service these high yield dividends, the model requires that the underlying net asset value, MNAV, of its Bitcoin holdings to appreciate at a rate that outpaces the cumulative interest liabilities. This treasury optimization model has gained traction globally. In Japan, Metaplanet has actively restructured its balance sheet to accumulate Bitcoin using similar debt issuance mechanics, while in the United States, the Ethereum focused operator BitMine Immersion filed a $300 million prospectus for a 9.5% perpetual preferred stock offering to build a corporate treasury of Tether or Ether, excuse me. These corporate strategies demonstrate a growing trend of utilizing traditional capital debt markets to secure hard digital collateral. Skull, what's your question, bro?
I didn't have a question. I just want to throw something out there.
Go
The
ahead,
ST,
bro.
the STRC is on the X stocks, and it pays the dividends on it too.
It pays the X stocks? Nice. I didn't know that. Oh, that's cold. That's cold. Thank you for that, bro. Thank you for that. You can drop the link in the chat for the people who might not know what the X stocks is. Because we've had access to a few IPOs before the IPO on X stocks. So feel free to drop that. Appreciate it, bro. Now, y'all might be seeing this and wondering what does all of this mean, back row? So, MicroStrategy or now Strategy has created interest on these preferred shares, preferred series, perpetual shares, which means forever. And they pay out dividends. The dividends that get paid out are not on the Bitcoin holdings, they are on the cash flow of the company. The cash flow of the company, not on the Bitcoin holdings. They have created one, two, three different instruments to accumulate Bitcoin. So they said, you know what? Hey, y'all want these interest rate payouts, right? Y'all want these payouts. Y'all want this interest rate. We're going to give you a exuberant amount of interest because we don't want the dollars. We want Bitcoin. They don't want the dollars. They don't care about the dollars. They want the Bitcoin. So they're going to give you what you want. You want dollars. Let me check the chat. Let me check the chat because man, we. Okay, Skull just dropped it. Appreciate you, Skull. So let me scroll down. These corporate strategies demonstrate a growing trend of utilizing traditional capital debt markets. Traditional capital debt markets. Traditional capital debt markets to secure hard digital collateral. All this is debt. That's all it is. And they're using debt to accumulate in hard asset. You cannot steal Bitcoin. You cannot confiscate Bitcoin. You cannot freeze Bitcoin because there's no CEO, there's no code to freeze, there's nobody at the head. It's pure math and science. Let y'all chew on that for a little bit as well. All right, moving on to the next portion. Mortgage finance, structural credit integration, and digital asset underwriting. Oh my goodness. This is one of my favorite parts, y'all. This is one of my favorite parts. So, if you're in business or if you have ever acquired a business, there's usually an underwriting process that happens when you're acquiring a cash flowing business or an asset, if you will. So this speaks to the how Bitcoin is being used for underwriting. The integration of digital wealth into the residential housing credit markets has led to the emergence of both conforming, agency compliant, and non agency asset depletion mortgage structures. Historically, digital asset holders faced a significant barrier to home ownership. Traditional underwriting standards required the liquidation of cryptocurrency holdings to fund cash down payments, triggering capital gains taxes of up to 20% or up to 37% for high earning short term holders, and forfeiting any exposure to future asset appreciation. This barrier is being lowered by a growing market segment. Demographics indicate that roughly 20% of the adult population in the United States, roughly approximately 52 million individuals, have owned digital assets, with younger buyers, Gen Z, and millennials being 2.5 times more likely to hold digital assets than older generations. Data from Redfin indicates that 12.7% of Gen Z millennial homebuyers have sold tokenized assets to fund a home down payment. I'm going to say that one more time. Hold on. Data from Redfin indicates that 12.7% of Gen Z and millennial homebuyers have sold tokenized assets to fund a home down payment. Conforming token-backed mortgages, the better Coinbase protocol. To address this demographic demand, AI native mortgage lender Better, in partnership with Coinbase, introduced the first conforming token-backed mortgage product. Designed to comply with the standard Fannie Mae conforming guidelines, this product allows borrowers to pledge Bitcoin or USD coin, USDC, as a down payment substitute without triggering a taxable liquidation event. Taxable liquidation event. Everybody on here pretty much already knows how to use Instadap, correct? Does everybody know how to use Instadap? Type 1 in the chat if you know how to use Instadap. Type 2 in the chat if you don't. Type 1 in the chat if you know how to use it. Type 2 in the chat if you don't. I need to know. This is a family reunion. And I pretty much showed everybody on here. Mm-hmm. Okay. Hold on. I got 1, I got 2, I got 3, I got 4, I got 5. Everybody on here knows how to use Instadap. I got 5 people on here. There's 8 people on the call. That means we're missing some. Okay, we got one more. That's 6. Let me see who else is on the call. Hold on. We got 8 people on the call, including myself. Okay. I know Brother Lemuel does. Perfect. All right. Info QPM LLC. Let me give you an explanation right quick. And then If you would like to move forward, I'm gonna drop my email in the chat for you. I'll show you exactly how to use this. So give me
Okay,
one
brother.
second. Let me drop my email in the chat. Micro web builders. Okay. Bam. That's my email. Let me explain this before I move forward. In InstaDebt, they allow you to use cryptocurrency as collateral to take out a loan. Say, for instance, you wanted to buy a home, and they are now have partnerships with Coinbase and a Fannie Mae registered product using USDC or Bitcoin as collateral for your home purchase. You could deposit USDC and then borrow against your USDC without ever selling your USDC. That USDC will now be a debt that you would owe to yourself. And in the event that if you were to ever, let's say, foreclose on that particular property that you were purchasing, you would still have the funds that you started with. The loan to value on USDC is 75%. That means that for every $100 that you deposit, you can borrow up to $75. No risk. No risk at all. The only risk would be if the platform was to shut down. And they actually have insurance now that allows us to protect the capital that we have placed into these types of protocols. So now that they have USDC as a down payment option, you could essentially do the exact same thing that they're already talking about that you can do. You're not going to sell your Bitcoin or you're not going to sell your USDC. So you're going to deposit your USDC, not Bitcoin, because you can't deposit Bitcoin into Instadap. You're going to use USDC as your collateral, and you're going to borrow against that collateral to give to this platform to give you that down payment that you need. Does that make sense?
Yeah, that makes sense. Okay.
Awesome. Awesome. Let me check the chat. Somebody said something in the chat. Okay, cool. The coordinated dual loan architecture. To maintain standard conforming status and secure low interest rates, the mortgage is underwritten as two distinct synchronized debt obligations. The primary conforming loan, a traditional home mortgage that complies with standard agency guidelines, enabling it to be packaged, securitized, and backed by Fannie Mae. The private secondary secured loan, a private non-conforming secondary lien originated by Better and secured by digital assets held in custody within Coinbase Prime. This secondary loan funds the cash down payment required to close the primary conforming mortgage. I think that's pretty damn dope. I like that. Now, the only thing that I don't like is that your assets are held within Coinbase. But again, you created a debt before you ever even bought your USDC into the picture. Create the debt first, not just give them your USDC or your Bitcoin. Me personally, I would use USDC because that's the coin that they're offering I'm not going to give you Bitcoin as collateral. For me, Bitcoin is entirely too powerful, and the price movements are astronomical. So USDC doesn't move; it's the stable coin. So I'm gonna give you the stable coin. I'm gonna keep my Bitcoin, and I'm gonna give you the stable coin. But I created a debt first that allowed me to create this mortgage. So essentially, I'm not really losing anything. True enough, they have my USDC held. And if they were to decide to ever shut down Coinbase Prime or anything happens with Coinbase, my assets are still held in my own wallet. I created a loan before I created a loan. You see what I'm saying? I created a loan before I created a loan. It allowed me to touch the money twice. And I say that often, especially with Instadat. You're allowed to touch the money twice. Why is that blacked out? Why is that blacked out? I don't know why that's blacked out. Hold on. Why is that blacked out? I don't know. That came out blacked out. I don't know why that came out blacked out. Okay, that's interesting. Let me check the chat. Somebody said, uh, okay. So what I mean by touching the money twice, sister life, I start. That's the cheat code blacked out. I'm about to see if I can fix that. Hold on, because that's crazy. I don't know why that's blacked out. Hold on, that's weird. Give me 1 second. Hold on. Let me see if I can remove that. I don't even know why that showed up as blacked out. Um, let's exit full screen for a second. None. And then text color is still black. Normal text. That is so weird. Primary conforming loan, standard Fannie Mae, home mortgage, secured by home. I'm gonna have to give y'all that formula later. I don't want to take away from the question that Sister Life had asked. Hold on. And then I want to make sure I get back to the right portion. Okay, perfect. I'll give y'all that formula in a second. Custody in the Coinbase Prime, strictly segregated, no hypothecation. Okay, okay, perfect. So, Sister Life, what I mean by touching the money twice. You start with fiat or cash or debit, credit, whatever you however you want to call it, and you purchase USDC. When you purchase USDC, you're going to deposit that USDC into Instadat. And you're going to have a collateral factor of up to 75%. You're going to borrow the maximum allowable amount on that USDC at 75%. When you borrow, that is now a debt, and you don't pay taxes on debt. Debts cannot be taxed. If you would have sold your USDC for cash, you would have to pay a tax. But because you didn't sell anything, you took out a loan, that USDC that you deposited is still sitting there. It's still there. It doesn't move until you move. And then I would take that loan that I just took out of my Instadap, and I'm going to use that now loan that I have in my possession in USDC, and I'm going to use that as collateral for a down payment on a property. Let me check a chat. Was that a better explanation? I hope it was. I think I get what you mean for because you borrow again on the loan. Yeah, exactly. You're welcome. I'm glad I was able to help with that. So, at the closing of the transaction, the borrower transfers the required digital asset pledge from their personal Coinbase account into Better's institutional custodial wallet at Coinbase Prime via a secure API. For a Bitcoin backed transaction of a 250% collateralization ratio is required, meaning that to receive a 40% down payment credit equivalent to a $40,000 down payment, the borrower must pledge 100,000 in Bitcoin. You see what I'm saying? You see what I'm saying? They want 100,000 in Bitcoin just to give you a credit. I'm not about to give you 100,000 in Bitcoin. I give you 100,000 in USDC, and you can give me a credit on that. So now that we have what they would be looking for, I'm going to go take 120,000 and I'm going to borrow against that 120,000 and I'm going to borrow 100,000 and then I'll give them 100,000 and allow them to give me a credit of that $40,000 down. And if I ever decide to back out of the deal, they'll give me back that 100,000. I'll give them back their 40,000 or the credit that they gave me, and I'll walk away with my capital still intact. I don't lose a dollar. If you don't understand that, drop a one in the chat. If you do, drop a two in the chat. And let's really get into this because that's what's taking place right now. That's what's really taking place right now is where are we going to bank and what are going to be the banking practices in this new digital transformation? Let's see what we got. Tools. I love it. I love it. Y'all are catching on. Everybody's following. Thank you. I appreciate that. Anybody else not following? There's more people. We got 8 people on the call, including myself. I need to know. I need to know. Not because and you might be a little hesitant on giving your answer right now because it kind of fuck with your head a little bit because you're not used to seeing it. You're not used to seeing that. There's a reason you're not used to seeing that. They never showed you that. And I'm talking about school, I'm talking about college, I'm talking about life. They never show you that. They never show you to view collateral or to view an asset to be used as collateral. They never show you that. All we ever think about is dollars and how dollars can be used and how when we accumulate dollars, how they pay for things. If you never heard me say this before, I need y'all to hear me right now. You should collateralize every dollar that you touch. Every dollar that you touch should be collateralized. Every dollar. Let's move forward. Unique consumer protection mechanics. Unlike traditional securities backed securities backed, or cryptocurrency backed private loans, this conforming product features unique borrower protections. Exclusion of margin calls. If the dollar price of Bitcoin drops during the mortgage term, the borrower is not subject to margin calls or forced collateral top ups. The terms of the loan remain unchanged. Mhm. Standardized 60-day delinquency liquidation. The liquidation of the pledged digital collateral is only triggered if the borrower falls into a 60-day payment delinquency on the home mortgage, aligning the collateral recovery timeline with standard residential foreclosure procedures. USDC yield offsetting. Borrowers who pledge or who choose to pledge USDC coin continue to earn institutional staking rewards on their locked collateral. You see why I would choose the USDC option? There's no yield on Bitcoin. It's only price appreciation. So let's say you locked up 100,000 in USDC. Where's my phone at? I need my calculator. Let's say you locked up, and what's the interest? What's the institutional interest right now? Hold on. These monthly yields can be dynamically routed to offset the principal and interest payments on the primary mortgage, reducing the net effective interest rate. So, check this out. Where's my calculator? Let's just say the interest rate on your mortgage is, what's the average interest rates right now? What's the average interest rate right now on to buy a home? Average, not where you currently live. What's the average? Can somebody look that up for me right quick while I do the calculations? And then drop it in the chat, or you can just come off mute and tell me. Nobody? Hold on. There we go. Okay. 6.48%, 6.48% on a 30-year mortgage. Okay, cool. All right, hold on. Give me 1 second. So, the board. My apologies. I sent somebody the wrong link. Give me 1 second. Okay. Let me see. Somebody else dropped something in the chat. Fixed mortgage. Okay, cool. All right. So 6.48%. 6.48%. Now, let's say the average yield that you will be receiving from your USDC is about, and it's variable, by the way. The yield that you will receive from your stablecoin deposit is variable. It can go from 1% to 50%. I've seen it as high as 33% most recently when the price of Bitcoin had dropped and everybody was looking for stable coins. So let's just say the average on stablecoin yield that you would receive is somewhere between 4 and 7%. That would effectively offset what the interest rate will be on a traditional loan or on a traditional mortgage. Okay. So borrowers who choose to pledge USDC coin continue to earn institutional staking rewards on their locked collateral. These monthly yields can be dynamically routed to offset the principal and interest payments on the primary mortgage, reducing the net effective interest rate. Coinbase One closing credit. Borrowers holding a Coinbase One membership are eligible to receive a rebate equal to 1% of the total mortgage value capped. Hold on, where is it capped at? It is capped at $10,000, paid directly by Better to cover standard closing costs. If you have a Coinbase One membership, you are eligible to receive a rebate to help with closing costs just to have a membership at Coinbase One. That's interesting. I like how they did that. That's interesting. That's very interesting. Well, let's look back at the interest rates right quick. So let's look back at the interest rates. So if I supply $100,000, right, and I'm getting, I don't know, let's say 4%. Let's say I'm getting 4% interest annually, not monthly, annually. And 4%, that's $4,000. Compounded though, 100,000, 4%. I'm gonna say, is that going to be monthly? Hold on, let's take a look. Let's take a look. Give me a second. So 100,000, 100,000 times 4% annualized annual interest compounded. Thank you. Okay, I was right. So I just wanted to make sure. So that would be $4,074.15 in interest. Now, you could take that interest and apply it to your deposit. The next year, you'll have $108,314. Year three, you'll have $112,727. Year four, you'll have $117,319. Year five, you'll have $122,100. Now, as that interest continues to accrue and you're redepositing that interest to your overall holding or your overall collateral deposit, that will ultimately offset what you owe on the mortgage, with traditional rates being somewhere around 6.7, 6.5%. So it's better to use USDC for a mortgage, not Bitcoin. Although you can use Bitcoin, but they don't say anything about the price of Bitcoin appreciation being used or that it could be used to pay up. But it did say that you can use this. You can not be subject to margin calls or forced collateral top ups because the price changed. So you're safe with using Bitcoin as collateral. Non-agency asset depletion integration. NewRez and Rocket Mortgage. In the non-agency and private mortgage markets, lenders have bypassed GSE guidelines to offer more flexible underwriting frameworks. NewRez has integrated digital asset validation into its Smart Series suite of non-agency loans. This program targets self-employed individuals and real estate investors through three specific structures. Smart Self allows self-employed borrowers to qualify using bank and 1099 statements while counting verified non-liquidated cryptocurrency holdings toward an overall reserve. Smart Edge, ideal for high net worth individuals allowing qualification based on entirely on asset depletion, counting verified holdings of Bitcoin, Ethereum, spot ETFs, and USD stablecoins toward the asset valuation. See how they're allowing the spot ETFs to be used? See how they're using Ethereum and stablecoins to be used for mortgages. SmartVest, tailored for real estate investors, using a property's projected debt service coverage ratio. Anybody do any real estate investing in this call right here? I'm quite sure we got a couple people on here that understand DSCR while allowing crypto assets to serve as verified liquid reserves. Under these guidelines, NewRez requires that the eligible digital assets be held with U.S. regulated exchanges, retail fintech platforms under state supervision, FINRA regulated brokerages, or OCC regulated national banks. Similarly, Rocket Mortgage has introduced options to recognize cryptocurrency holdings during underwriting. In their collateral based model, crypto is transferred to a designated escrow custodian, while their income based model recognizes the verified value of crypto holdings as qualifying liquid reserves without requiring liquidation or a transfer of title. This broader recognition follows a summer 2025 directive from the Federal Housing Finance Agency, FHFA, which formally required Fannie Mae and Freddie Mac to consider cryptocurrency holdings in risk assessments for single family mortgage loans. You can use crypto as collateral for mortgages. And they have different programs for different types of mortgages. Now, these mortgages will be securitized. If you don't know anything about how mortgages work in this world, they are securitized by debt ladders. So let me give you a brief scenario. They're called tranches. With tranches, you have scores, much like credit scores. You got AAA rated, triple B rated, double B rated, double A rated, C rated, double C rated, triple C rated, D rated, double D rated, triple D rated, so on and so forth, all the way down to the dog shit. As we move towards the underwriting using crypto as collateral for loans and mortgages, they are going to tokenize those loans and mortgages. And they're going to allow for investors to purchase the token that has a model inside of it that is currently performing either better or worse than the overall market. So you can either have a non-performing asset or a non-performing debt-backed token or a performing debt-backed token. And those will be bought and sold just like they are today. That shit is beautiful. We are literally seeing this shit in real time. Let's move forward. Comparative financial modeling of underwriting options. While token-backed mortgages offer tax and liquidity advantages, they introduce higher monthly carrying costs due to borrowing 100% of the purchase price. The following model compares a traditional conforming mortgage against two token-backed configurations for a $500,000 home purchase, assuming a borrower uses $100,000 in highly appreciated Bitcoin to fund a 10% down payment equivalent $250,000 collateralization ratio. Let's take a look at the underwriting. So, underwriting parameter, the traditional conforming loan, which is the 10% cash down, conforming token backed mortgage based conforming rate is $100,000 in Bitcoin. Conforming token backed mortgage max risk premium. Pledge Bitcoin collateral would be none. The conforming token backed mortgage would be 100,000 in Bitcoin, and the conforming token backed mortgage max risk premium would be 100,000 in Bitcoin. Jazz wants to come in.
Yes.
Okay. Okay. Cool. You almost done? Yeah, I'm almost done. Okay. Thank you, beautiful. Okay. What you going to start again? Okay. I don't know. Okay. Did you move that cash that was right here? Okay. Okay. Thank you. All right. The initial down payment credit is the baseline. Upfront cash down payment is going to be $50,000 in cash. 40% of the collateral would be 40,000 in cash, and 40% of the collateral value, which would be the same $40,000 in cash. Now, capital gains tax incurred if you were to liquidate your Bitcoin. You're going to pay $6,000 in capital gains. That's a minus. Total cash required at closing is going to be $86,000 down payment and taxes, 40,000 if you're doing the 40%. The primary mortgage interest rate is going to be roughly 6%. Premium would be 7.5%, and adjusted for 1.5% risk premium. Your monthly payment using said Bitcoin as collateral would be around $2,698 or $2,998. The excess monthly carrying costs would be around $300 a month, or with the premium would be around $788. So your 10-year excess cost baseline is roughly between $36,000 and $95,000, depending upon how much of the collateral you commit. Risk assessment and criticisms. Economist Peter Schiff and other financial analysts have raised several structural concerns regarding token-backed conforming mortgages. The full leverage problem. Because the down payment is funded through a secondary loan secured by a volatile digital collateral, the home buyer holds zero real equity in the property. The full leverage approach exposes the primary lender to default risk, as a downturn in both the housing and crypto markets could leave the loan under collateralized. Yes, I do.
You want anything?
No fountain drink. Give me one of those elevator waters.
They have them there?
Yeah, they got it. It's the big one.
The yellow or the green?
Yellow or green is fine.
Give me for extra.
Go ahead and take what you need. Okay. Or here, just here. Use this because I don't want to use that because that's for another purpose.
The card.
Yeah.
Pin numbers and shit.
Nah, we good.
Can I just use it as credit?
Yep, you sure can.
If not, it's the same thing.
Here. Yep. Okay, beautiful. So basically, what they're saying is crypto is volatile, and your mortgage could end up being under collateralized. So if your mortgage is under collateralized, how do we fix the underwriting problems to where you would not be under collateralized for your particular loan? Which is the reason why I keep going back to USDC, because USDC doesn't fluctuate, it stays the same. So to avoid a one-time capital gains tax of $9,250 calculated at a short-term rate on appreciated Bitcoin, a borrower utilizing the premium rate token backed mortgage would pay an additional $3,600 to $9,576 every year in interest payments over a 10-year holding period. This translates to an extra cost of $36,000 to $95,000, making the tax avoidance strategy mathematically disadvantageous for long-term homeowners. The USDC arbitrage disadvantage. Somebody's calling me. He's have to call me back. Okay. Pledging a stablecoin like USDC to secure a secondary home loan at interest rates above the primary conforming mortgage rate is financially inefficient. Because stablecoins do not appreciate, the borrower is paying a high interest rate to borrow against a dollar peg stable asset that could instead be liquidated directly to fund the down payment without a meaningful tax penalty. Now, what I didn't include was the InstaDAP strategy. I should have included that in the paragraph. The borrower is paying a high interest rate to borrow against a dollar peg stable asset that could instead be liquidated directly to fund the down payment without any meaningful tax penalty, regulatory, and political friction. This credit integration has faced pushback. A coalition of U.S. senators formally petitioned the FHFA, warning that integrating highly volatile digital assets into the conforming underwriting standards of Fannie Mae and Freddie Mac introduces unnecessary systemic risk to the broader housing finance and mortgage-backed securities markets. Now, what they're afraid of, and I'm gonna tell you what they're afraid of. The reason why they don't want you using the stable coins or they don't want you using Bitcoin, one is you're going to have to over collateralize the asset and you cannot rehypothecate without permission. That means that every asset that you give custody to, like Coinbase or a state chartered bank or a state chartered trust, they have to have your asset one to one and they cannot lend out to anyone. The banking regime that we're currently under right now, you are able to lend out your dollar as soon as you make a deposit. Banks can lend out your dollar. They can take your dollar and they can make 10 more dollars. And by the time you get done with it, that shit been turned into a whole mortgage. So they turn your $10 or your $1,000 or your $10,000 deposit or your current money that you have in their bank, it's no longer yours. And they created hundreds of thousands or hundreds of millions or hundreds of billions of dollars. The new regime says that you have to have one to one. If I deposit a dollar, that dollar has to stay there. If I deposit a dollar under the new regime, that stays there. Let's keep it pushing. State by state fiduciary paradigms. special purpose charters, and trust company integration. In the absence of a unified federal regulatory framework, the legal and operational infrastructure for digital asset custody has been established at the state level. State chartered limited purpose trust companies and specialty banking charters have emerged as the primary legal bridge between digital assets and traditional banking rails. Wyoming, Special Purpose Depository Institutions, SPDIs. Wyoming has established a highly specialized banking and digital asset custody framework in the United States. Statutory based and digital asset UCC framework, enacted under House Bill 74 and Senate File 125 in 2019, the state established the Special Purpose Depository Institutions Act, alongside a comprehensive digital asset commercial code. Anybody familiar with commercial codes? I know y'all are. I know y'all are, because we talked. I know y'all familiar with commercial codes. The digital asset laws classify these assets as property. The digital asset laws classify these assets as property under the Wyoming Uniform Commercial Code, establishing clear rules for perfecting security interests and establishing legal control of digital assets. Operational architecture. Hold on one second. Hold on. No, Jazz. No. No. Absolutely not. You cannot chew on my computer cord. Unless you want to go to doggy heaven, you can't chew on this. Go sit down. Move, socks. Move. Sorry about that, y'all. I got dogs under my desk right now. Then let me open this for the missus. Give me 1 second. Get down, Jazz. I don't know what you're thinking about, girl. My apologies, y'all. I'm on dog duty right now. Okay. Operational architecture. Wyoming SPDIs operate as fully reserved custody banks. Their primary operational rules include strict prohibition on fractional reserve lending. They are prohibited from fractional reserve lending. SPDIs are legally prohibited from lending customer fiat deposits. Does your bank do that? Nope, your bank doesn't do that. It will. That's coming very soon. Get down, Jazz. I see I'm gonna have to fight you today, Jazz. I'm gonna have to fight you today. 100% high quality liquid asset backing. All customer fiat deposits must be backed 100% or more at all times by unencumbered liquid assets, restricted to U.S. currency and level 1 high quality liquid assets. This fully reserved requirement exempts SPDIs from mandatory FDIC insurance. Corporate capitalization and governance. Organizers must maintain a minimum capital requirement of $5 million to obtain a charter. And the institution's principal operating headquarters and its CEO primary office must be located in Wyoming. I'm going to go back because y'all might have missed that. Corporate capitalization and governance. An organizer must maintain a minimum capital requirement minimum of $5 million to obtain a charter. If you don't understand what I mean, you only need $5 million to obtain a bank in Wyoming. You only need 5 million. We could put that together. You might be able to put that together by yourself, but we could put that together as a group. 5 million, that's it. That ain't shit. And the institutional's principal operating headquarters and its CEO primary office must be located in Wyoming. We don't have a problem with that at all. Wyoming sandboxes and tokenized equities. Wyoming banking regulations permit corporations to issue stock via tokenized certificate. Come here, Jazz. Come here. Come here, Jazzy. Come here. Come here. Come sit down. Because you messing stuff up. And you're not being right now. So come here. Come here. Come here. We're gonna talk about that later. Because you just knocked down my whole projector. Okay? Sit down. Lay down. Right here. Be good. Okay. Thank you. Say what's up to the people. Okay. All right. Be good. Thank you. Wyoming sandboxes and tokenized equities. Wyoming banking regulations permit corporations to issue stock via tokenized certificate representations in lieu of traditional paper certificates and provide a fintech sandbox to grant temporary regulatory waivers for experimental financial services. We're getting a waiver to create a bank. If I'm not mistaken, I believe the waiver is 4 years. It's either 4 or 5 years. You get 4 years to play in a fintech sandbox where you can create your own bank. I done went too far. Hold on. My bad, y'all. Watch out, Jazz. You're supposed to be laying down. There we go. Where are we at? Where are we at? Go back. Hold on. I hate when I lose my place. The arbitrage disadvantage, SPDIs, right up in here. There we go. Thank you. Right about here. Case studies and regulatory parity. The Wyoming Division of Banking has approved 4 SPDI charters, including Kraken Bank. Kraken has a bank. Avanti Bank and Trust, now Custodia Bank, approved October 2020, which was chartered to issue a tokenized, fully reserved US dollar payment instrument called AVIT. A major, what you got, Jess? Okay. A major strategic advantage of the SPDI charter is its potential to bypass state-by-state money transmitter licensing requirements. I'm going to say that one more time. A major strategic advantage of the SPDI charter is its potential use to bypass state-by-state money transmitter licensing requirements. I would Google that if I were you. Under the Federal Bank Secrecy Act, banks are exempt. Banks are exempt from state MTM rules. Banks are exempt from state MTL rules. Wyoming SPDI advocates rely on the Regal-Neal Amendments Act, which establishes regulatory parity between national banks and state chartered banks. Under this theory, because New York exempts national banks from its BIT license requirement, New York must grant New York must grant equal treatment to state chartered banks from other states, including Wyoming SPDIs. However, this legal theory, hey, sit down, Sox. Hey, have a seat. Hold on, you know. Give me 1 second. My apologies. That's what happens when you're on dog duty and you're supposed to be doing something. Sox, sit down. Sit down. Okay. Come here. Right here. Sit down. Down. My apologies. Come here. Come here. Right here. Stay here. Wyoming SPDI advocates rely on the Regal-Neal Amendments Act, which establishes regulatory parity between national banks and state chartered banks. Under this theory, because New York exempts national banks from its BIT license requirement, New York must grant equal treatment to state chartered banks from other states, including Wyoming SPDIs. However, this legal theory remains untested in court, and the New York State Department of Financial Services has not formally recognized this exemption. Pay attention to that. Texas, regulatory notices, UCC modernization, and proof of reserves. Texas has integrated digital assets into its banking system through regulatory notices, UCC amendments, and strict consumer protection laws. Early guidance and stablecoin treatment. The Texas Department of Banking was an early regulator in this space, publishing Supervisory Memorandum 1037 in 2014. The Supervisor Memorandum 1037 in 2014. The memorandum concluded that decentralized currencies like Bitcoin do not fit the statutory definition of currency or money under the Texas Money Services Act, meaning that trading them does not on its own trigger money licensing, money transmission licensing. However, in 2019, Texas revised the memorandum to clarify that stablecoins backed by sovereign fiat currency are classified as monetary value under Chapter 151 of the Texas Finance Code, requiring any platform transmitting stablecoin to hold a Texas money transmission license. During the 87th legislation session, Texas enacted HB 4474, formally amending the Texas Business and Commerce Code to establish clear rules for how security interest in a virtual currency is perfected and how legal control is established under the UCC. Banking Custody Guidelines, Industry Notice 2021-03. In June 2021, the Texas Department of Banking issued Industry Notice 2021-03, confirming that Texas state chartered banks have the authority to provide virtual currency custody services under Texas Finance Code subsection 32.001. The notice defines two custodial capacities: non-fiduciary capacity, bailee relationship. The bank acts strictly as a bailee for safekeeping That sounds like a safekeeping receipt if you know about gold. The legal title remains with the customer, and the bank owes a duty of proper care to return the cryptographic keys or assets unharmed. Fiduciary capacity, trust authority. The bank must secure trust powers via a charter amendment and comply with 7 Texas administrative codes. Subsection 3.23. The capacity grants the bank the authority to actively manage the digital asset on behalf of the consumer, unlike depository banks. Texas limited purpose trust companies, LPTCs, do not qualify for automatic banking exemptions under the Money Services Act due to their lack of federal deposit insurance. LPTCs must obtain a money transmission license if they engage in licensable custody or transfer activities. The Proof of Reserves Act, HB 1666, following major platform insolvencies. Following major platform insolvencies, Texas passed HB 1666, accompanied by SB 770, creating Chapter 160 of the Texas Finance Code, effective September 1st, 2023, known as the Texas Proof of Reserves Bill. The law applies to digital asset service providers, electronic platforms, and facilitating trading and maintaining custody of customer digital assets in Texas. The statute prohibits platforms from commingling customer funds with corporate assets, using one customer's assets to guarantee another's transactions, or restricting customer withdrawals. Platforms must provide customers with quarterly balance reporting and submit an annual proof of reserves CPA attestation to the Texas Department of Banking under the AICPA standards. Traditional state and national banks are explicitly exempt from these requirements as they already are subject to prudential banking supervision. South Dakota, public trust, CITES, and taxation, federal conversions. Excuse me. I'm getting tongue-tied like a motherfucker. Do y'all see where I'm going with this? I know I'm reading a lot, but I really want y'all to see where we are really going with the whole Bitcoin conversation. They already have banking frameworks in every single state, not just in states that I'm naming. They have banking regulations in every state that enforces digital assets. Not just crypto, not just Bitcoin, digital assets as a framework. And South Dakota has leveraged its trust laws to become a leading jurisdiction for institutional digital asset custodians, capitalization, fees, and taxation frameworks. Public and private trust companies in South Dakota are chartered under SDCL 51A-6A and regulated by the South Dakota Division of Banking. The state enforces a robust operational and capitalization framework, minimum capital and bond requirements. Trust companies must maintain capital. Trust companies must maintain capital of at least $200,000 alongside a fidelity bond and a directors and officers D&O liability insurance policy of at least $1 million each and a pledge deposit of at least $100,000 to the Division of Banking. Annual supervisory fees. The state levies an annual supervisory fee calculated at 7 cents per $10,000 of total trust assets under management administration for custody. Excuse me. Thank you,
You're
beautiful.
welcome. Here,
I appreciate it. You can just say it right there.
your card.
Okay. Private trust companies are subject to a minimum fee of $3,750 and a maximum fee of $20,000, while public trust companies face a minimum of $4,500 and a maximum of $30,000. Tiered financial institution tax under SDCL, excuse me, 1043-1. Trust companies are taxed as financial institutions. The minimum tax under SDCL 1043-90 is tiered over the first 5 years of operation. $500 for less than 12 months, $2,000 for 12 to 24 months, $5,000 for 24 to 36 months, $10,000 for 36 to 48 months, and $25,000 annually after 48 months of operation. You can create a sandbox in South Dakota. And in the first year, that could be $500 to create a sandbox. Case studies and national charter conversions. I want to highlight this one right here. The Anchorage Trust Company, chartered as a South Dakota non-depository public trust company in 2019. The firm received OCC approval on January 13, 2021 to convert to Anchorage Digital Bank. If you don't know who Anchorage is, they are responsible for AVAX. I'm going to say that one more time. They are responsible for AVAX. Let me pause right here for a second because I've been talking a lot. Does anybody have any questions so far? I got about 10 more pages that I need to read. Does anybody have any questions? Let me make sure I'm not putting y'all to sleep and y'all are following along. Ask questions. Pretty please. Or what are your thoughts so far? Let me ask that. I got 9 people on the call, including myself. What's up? No questions? Just listening? Just soaking it up? What you got?
Soaking it up. So, yeah, it's next level because now we can use it as collateral to buy our own homes. Basically, is what you're saying, correct?
Not only buy your own home, I'm talking about create your own bank.
Right. Okay. No, because there was something else earlier you had said, and I was thinking along that.
Not just buy your own home, sister life. I'm talking about creating your bank and not being charged a lot to do so in the first 4 years. That's the one thing that I want y'all to take away from this is that these are already things that have happened. And we are seeing in real time how much it costs to even create a bank in these particular states. So, I'm finished up. Let me finish up. 'Cause I might be going over y'all head a little bit. I know it's high level. I know everybody is familiar with BitGo. BitGo has the trust company. New York Limited Purpose Trust, bit licenses, and NYDF custody rules. I feel like I need to go over this. I feel like I need to cover this as well before I just start skimming through, because I don't want to put y'all to sleep. New York maintains a highly active regulatory framework for digital asset custody through the NYDFS. Codifying statutes, Senate Bill S 3262. To formalize its regulatory procedures, New York introduced Senate Bill S 3262 in 2025, sponsored by Senator Coney. The bill amends the banking law and financial services law to establish a framework, a statutory framework for limited purposes trust companies. Section 157 sets forth corporate application procedures requiring a charter and fitness review of directors and management. Somebody just dropped something in the chat. Hold on. Make sure I'm following the chat as well. So Sister Life just said, so yes, we can create our own trust and form our own banks via the trust. Thank you, Sister Life. That is what I want y'all to see.
Don't forget the privately.
Privately, a trust can create a Bitcoin backed, stable coin backed fiduciary responsibilities, and it is all being done on the state level. It's not even federal yet. That is what I wanted y'all to see tonight. You can create your own bank. Section 157 sets forth the corporate application procedures requiring a charter and fitness review of directors and management. Section 158 establishes standards for safe and secure operations, requiring trust companies to maintain at least 3 board members, appoint a president/CEO, a secretary, and a general counsel, and submit a 3-year business plan with detailed financial projections. Section 159 establishes safeguards for stablecoin and digital asset operations, requiring companies to submit internal audit and control plans, retain a full-time internal auditor, and engage in an independent CPA firm for external audits. Let me scroll down. The NYDFS manages virtual currency businesses through the national or the nationwide multi-state licensing system, MNLS. As of June 22nd, June 2022, 9 major virtual currency businesses operated under a New York limited purpose trust charter, including Coinbase, Fidelity, Gemini, Bakkt, Paxos. Comprehensive custody standards and enforcement. Following a wave of insolvencies in the digital asset market, the NYDFS updated its asset custody guidance on September 30th, 2025. The guidance established 4 key compliance areas: absolute segregation of customer assets. Custodians must keep customer virtual currency strictly separate from corporate capital, both on chain and on internal ledgers. If omnibus accounts are used, the custodian must maintain clear internal records to identify each customer's beneficial interest. When you're dealing with a trust, it has to be beneficial interest for everyone. It has to be beneficial trust for everyone. So our crypto assets would fund or be used as collateral for the trust. That is correct. You're going to supply your assets and you have to maintain a certain dollar amount based on the state where you create your bank. This is all in New York that I'm reading right now. This is all New York. So pay attention. Where I'm at, right here. Limited custodial interest. No hypothecation. Custodians take possession of assets solely for safekeeping and custody. The guidance prohibits the establishment of a debtor/creditor relationship and bans the use of customer assets to secure, guarantee, or extend credit for corporate purposes. Sub-custody due diligence. The establishment of any sub-custody arrangement is treated as a material change in business, requiring prior NYDFS approval. Sub-custodians must either be licensed by the NYDFS or subject to a substantially similar supervisory regime in their home jurisdiction. Pulls it down. Enhanced consumer disclosures. Custodians must disclose the precise legal terms, property interests, and risk parameters of their services and secure written acknowledgments from customers before facilitating transactions. NYDFS actively enforces these rules. In a 2025 consent order, Paxos Trust Company agreed to pay $26.5 million in a civil penalty and commit $22 million to a compliance remediation to resolve allegations of a deficient KYC controls, LAX, BSA, AML KYC policies, and a failure to monitor transactions related to its stablecoin distribution partnership with Binance. This enforcement underscores that New York's limited purpose trust company charter requires rigorous compliance and active state supervision. State by state comparative matrix of banking and trust frameworks. Let's take a look. So we're looking at the diverse state approaches to digital asset integration highlight the variations in the regulatory landscape. They highlight Wyoming, Texas, South Dakota, and New York. Everybody's going to get a copy of this. I'm not going to read straight through that. Excuse me. The federal catalyst. Now we're getting into the federal portion. I hope I still got y'all. I really hope I do. Because I'm literally giving y'all the keys on how you can create your own bank using digital assets. Y'all thought this was going to be a Bitcoin class. No Bitcoin class over here. The federal catalyst. The SEC, September the 30th, 2025, no action letter. The defining catalyst for the institutionalization of state charter trust companies occurred on September the 30th, 2025, when the SEC's Division of Investment Management issued a landmark no action letter to Simpson, Thatcher, and Bartlett. This administrative action officially withdrew the SEC's previous 2020 guidance, which had left a 5-year gray area regarding whether the trust companies could serve as qualified custodians under federal securities laws. What's up, beautiful?
I'm sorry.
What's up?
I need to wrap it up. I need to eat your
I'm eating my dinner as I'm talking.
I gave you that 30 minutes.
That was 30 minutes ago?
Yeah, and I
Damn.
just outside for a check.
Okay. Tell him it's up under the tarp.
It's not like
Okay. All right. I'll be on in a minute.
he's with Justin.
Okay.
So
Okay. I got you.
I'm saying, but
Okay. Cool. This administrative action officially withdrew the SEC's previous 2020 guidance, which have left a 5-year gray area regarding whether the state trust companies could serve as qualified custodians under federal securities laws. The qualified custodian dilemma. Under the Investment Advisors Act of 1940 and the Investment Company Act of 1940, registered investment advisors, RIAs, and registered investment companies, RICs, are required to place client funds and securities within a qualified custodian to protect against theft, loss, or misappropriation. While the statuses define qualified custodians to include banks, it was legally ambiguous whether state chartered trust companies met this definition. To qualify as a bank under the 1940s Act, an institution must prove that a substantial portion of its business consists of receiving deposits or exercising fiduciary powers similar to those permitted to national banks. The SEC's previous regulatory stance included Staff Accounting Bulletin 121 SAB 121 and a proposed but later withdrawn safeguarding rule discouraged traditional banks from taking custody of digital assets by requiring them to report custody crypto as a liability on their balance sheets. This created a challenge. Traditional banks avoided crypto custody due to regulatory constraints, while state chartered trust companies, which had developed advanced digital asset custody frameworks, faced legal uncertainty regarding their status as qualified custodians. The SEC's first custody related enforcement action against Glorious Capital Management 2024, which penalized the fine for placing crypto assets in trading platform accounts that did not meet qualified custodian standards, underscored the urgent need for regulatory clarity. Core compliance criteria for state trust companies. The September 30th, 2025, no action letter resolved this uncertainty by confirming that the SEC will not recommend enforcement action if a RIA or RIC treats a state chartered trust company as a bank for the purpose of custodying digital assets. So that's another thing that you all need to be focused on as well, is that you're not going to be a bank per se. You're just going to be a bank for digital assets where you'll be able to custody digital assets. That's a completely different bank. Now, 5 key operational requirements. Explicit state banking or authority. The trust company must be formally authorized by its relevant state banking authority to provide custody services. Third-party audited financial statements. The trust company must provide annual financial statements audited by an independent public accountant under GAAP, independent internal controls. The trust company must provide its most recent written internal control report prepared by an independent public accountant, such as a SOC-1 or SOC-2 Type 2 report verifying the design and operational efficiency of its custodial controls. Prohibition and rehypothecation and enforcement of segregation. The trust company must enter into a written agreement with the RIA or fund stating that it will not directly or indirectly lend, pledge, or hypothecate custodial funds and must keep all custodial assets strictly segregated from its own corporate assets. Written policies for digital asset safeguarding. The trust company must implement robust written policies and procedures to safeguard digital assets from theft, loss, or misappropriation, including advanced private key management and cybersecurity controls. Additionally, utilizing RIA or fund must perform an initial and ongoing best interest determination, verify the trust company's operational capabilities, and clearly disclose any material risk of using state chartered trust companies as custodians to their clients and board of directors. Now, this right here focuses on the federal versus state custody regimes under the NAL framework. So, the Office of the Comptroller of Currency, State Banking Authority, ergo NYDFS, the South Dakota Division of Banking, automatic statutory qualification under the National Bank Act, conditional qualification based on state level supervision and fiduciary authority, deposit taking authority, permitted though often through limited to trust deposits, generally prohibited, fully reserved, or non-depository frameworks, supervisory oversight, centralized uniform federal examination program, state-by-state examinations, varying regulatory standards, and resources. Now, the final part that I want to leave y'all with, and I'm going to make sure I get everybody a copy of this. There are several banks in several states for sale right now. Those banks are either underutilizing the assets that they currently have in their possession, or they have not yet been transitioned to a digital asset custodian. We could buy these banks, turn them into digital asset custodian banks or state chartered trust banks, and reissue or tokenize the total undervalued asset of a bank. If we were to tokenize those assets, there's no telling how much is in that particular asset. You could buy a bank for dirt cheap, and they could have billions of dollars in assets. That is one thing that I want y'all to take away from this, is that banks are very cheap to acquire. It just takes some real legal legwork. So I'm gonna end that right there, because I know we are over on time. I've probably been over on time. Some of y'all are probably asleep. I'm sorry about that, but I had to give y'all the real of what is going on with crypto and with Bitcoin. Seriously. So before I close it out, let me read the chat. Does anybody have any questions as to everything that I've read? Anybody? Anybody at all? Nobody?
Can you repeat it? I'm sorry, I have one.
No, I just was asking if anybody had any questions, Sister Life. Again, I know I could jump over a lot of people's heads sometimes, and sometimes it's a little difficult to comprehend all all of everything that I just explained. But I would highly, highly recommend rewatching this replay. And then, like I said, everybody who has joined this um, webinar, I will be sure to get you all the recording, and I will be sure to get you the document that I have created. And since nobody has any questions,
No, yes, I
everybody,
will. I think what it is though is just so unbelievable
yeah, it
of
is,
like it's just grasping it all. Like
yeah,
even with I know like I go way back with learning from you and a few others and different things, but it's like certain things are just now clicking too, even with me. And it's
mm-hmm,
like as we're looking at and seeing things how are unfolded, and
mm-hmm.
even with seeing it, it's still because it's like nah, but it's like but this is where us we got to be like, never mind that doubt and that nah, what we used to and
mm-hmm,
how we used to thinking, and just
mm-hmm,
like take a jump of faith, a leap of faith, basically
mm-hmm,
like trust and believe in what you're actually seeing, even if it seems unreal to be true. You know what I mean? So
mm-hmm.
that's what I could say. I know I'm a little slow and delayed, like in delay in catching up and because yeah, the instant that like I still haven't fully grasped it, but I get it, and but I haven't been using it in the capacity in which I should. That's and that's on me for lack of just putting myself to just go back and study and just use it because
Mm-hmm.
that's what I'm saying. Like even if you just checking your wallet, yeah, over the years you got to put it in action. And
Absolutely.
then it easy peasy like how you and the rest. But nah, I think that's what it is. It's just so hard to conceptualize and recognize like the magic is in our hands right now.
Right. Absolutely.
That's it.
Absolutely.
I give thanks to yourself and all others who've been teaching this from the beginning. Mom, sit down for a second. Okay, let me shut it down. I mean, I'm still listening. I'm gonna just mute. But
No, you good. You good.
appreciate you. Thank you.
Mm-hmm. No doubt. All right, so I'm gonna get up out of here because I gotta eat dinner. And I'll wrap with y'all on the next free webinar that I do. 'Cause we're gonna do a lot more of these. We need to start getting more involved, way more involved. So I'm gonna go ahead
Appreciate
and end this recording, and I appreciate everybody that was able to jump on, man. Y'all have a
appreciate you.
good rest of y'all evening.
All right, brother. Peace out.
All right, peace, y'all.
Peace and love.